Why do you get so emotional with stock prices? Today, I want to talk about the role of emotions in investing. Now, this may seem like a topic that doesn't really fit the sort of very analytical and research oriented process that is investing, except it actually plays a critical role. In fact, 98% of professional money managers fail to beat the S&P 500 on a decade period, in a large part because they let their emotions get ahead of themselves. And so today I want to talk about why this happens and what you can do about it. Now, this plays in to the research you do on a specific business. In a past video, we talked about what a good business does. It creates value, it captures that value, and it protects that value. Now, that shows up in the form of cash flows. As an investor, it is your job to estimate out these cash flows and then value them. If that is what you are doing as an investor, then you are much less likely to be bothered by the stock price movements. Now, a stock will change its price every single day that the market is open. And there are a myriad of reasons as to why that is the case. It could be that there is some news out there that impacts the company. It could be something as broad as potential legislation that is expected to have a downstream impact. It could be changes in currency in a foreign country where maybe they have a supply base. It could really be anything. But I am here to tell you, almost always, the stock price moving has very little to do with the actual business. If you think about what is happening when a stock is being sold, there is someone on the other end buying it. What that means is that for whatever reason this one person wanted to sell it, someone else wanted to buy it. Now, when a stock drops in price, there's this sort of idea that the seller, for some reason, knows something that you do not. And that is why it is a little scary when we see stock prices drop a lot. But I am here to tell you, as someone that has worked at Goldman Sachs, one of the largest investment banks, and also someone that worked at a very large mutual fund, who watched the discussions around the decisions to sell billions of dollars of stock, I can tell you that very often it is not the case that they know something that you don't. In fact, they are all asking the same questions, wondering what is driving the stock price. And I say all of this to give you comfort, because when you see that the stock prices are moving, you should not automatically assume they know something you do not. Now, let's back up for a second. Why did you invest in this company in the first place? If the first thing that drew you to that company was a low price, the fact that the price dropped, then that means the price is what is going to drive you. And so every day you are going to check the price of the stock and think of that as a sort of validation as to whether or not you made a good decision, instead of thinking back to that sort of analysis you did to figure out what the company's cash flows would be and different things that can impact it. Now, on an average day, a stock can drop 3%. It could drop 5%. Sometimes it may drop 10, 20, or more. Now, single day drops above 10% are rare, except they do happen. And it is your job as the investor to feel so confident in your knowledge of the business that when it does happen, you are not sitting there wondering, what does the seller know that I do not know? Instead, you're going back to your analysis. You're thinking, here are the risks that I have identified. Has anything taken place that makes one of these risks more likely? Is there something else I didn't think of? If my analysis is the same, then I do not have to worry about the stock price falling. That is why it is so important you do thorough analysis and you understand why you are invested in what you are invested in. Because if you do not know this, then what is going to happen is the stock price is going to dictate your emotions. And that is exactly where I wanted to land us. Now think about what happens when you are watching your brokerage account fall in value. Thousands of dollars, maybe millions of dollars, and you are feeling a little bit of disgust with yourself. Did you make a terrible decision investing in this business? Well, I'm going to give you the good news and the bad news. The bad news is if you are asking this question simply because the stock price is falling, the answer is probably yes. Except it's not because the stock price is falling. It was a bad decision because you let the price dictate why you owned it. Now, a good investor may still feel fear and emotions around a stock price dropping, except that is not what is driving them. What is driving them is their analysis and understanding they have of the business. And so when they are in a situation that the stock market is down maybe 30% like it was during COVID, they are able to sit back and understand why they bought what they bought. Now, that was a very specific instance where there was a lot of unknown in the world. But the more confidence you had in your business and the quality of business it was, the more confidence you could have had in that moment and not have panic sold. And of course, if you did sell in that moment and you did act on those emotions, you would have had the opposite emotions thereafter. You would have then felt like you missed the big gain. And then instead of trying to again rationally analyze the situation, you would have let your emotions drive you again, and you would want to sit out the rally. This is really common, by the way, that if someone sells at the bottom, they very often will never want to enter the market for a long period of time, feeling that they need to justify their decision in a way. And also, once the gains start occurring, they feel like they already missed out. This is not how you should invest whatsoever. You should not be so focused on the price. You should be focused on the value. Now, I'm going to tell you there's two main reasons why people make this mistake. The first one we talked about, which is that they don't understand what they purchased. And very often it could be the case they heard about it on the news, a friend gave them a stock tip, they read something on Twitter, and they just plowed their money into it without understanding why, because they really were just hoping it would go up. And it was basically a gamble. Now, if that was not you though, and you did do actual diligence and research, there still could be a second mistake, which is that you put too much money into that single investment, or you put money that should have been reserved for living, or you put money that you needed to live off of into that investment. And so that is another really important thing, is portfolio positioning. When you are making an investment, you want to make sure you're not putting so much in it that should there be a period where it declines in value, you are forced to sell it because you need that money to live off of. Now, this is kind of a hidden factor that people do not usually think about, but it is ever present. If you are invested in a company, let's say Amazon in the early 2000s, you had a multi-year period where the stock was down a lot. And if you were requiring that money to live off of, you would have been forced to sell and would have missed all of the gains thereafter. And that is why it is important. You are only investing money that you do not need to live off of. And so the most important thing to understand is that if the price is what drew you to a stock, then it is what is going to drive your emotions. And your emotions are going to take you wherever they want to take you. But I can promise you, it is not going to be where you want to go. And now, if you're still unclear on the exact distinction between price and value, make sure you watch this video here.